Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Sonu, you're fired.
Uh-oh.
episode 147 in Carson's Facts versus Feelings. You know where this is going.
Yeah. Thankfully, my boss is a little less mercurial, I should say, than the president. So I am grateful for that.
That is, jeez, better be. Anyway, let's just dive in. You know, sometimes we do small talk. We've got a ton to talk about. We'll probably get to small talk, maybe more into it. Let's start with that jobs number, right? The jobs number, again, high level.
Diving into it.
Came in lower than expected. Saw the huge revisions. I know you've got all the numbers and the stats. We're going to get into it. But then a little bit later, President Trump literally fired. That's the play on you're fired. Fired. What was her name? The BLS commissioner. McIntyre, who was appointed in 2023 by the Senate. It was like 83-8. JD Vance,
including JD
Vance and Marco Rubio. And anyway, so we're going to dive into all this stuff, but just be aware that she was widely appointed by just about everybody. As 8 people didn't vote for her, so I don't know who those 8 were. Maybe we'll talk to them. But let's start with why were you surprised the jobs number missed? Let's get to the revisions next. I mean, I know the revisions are the big part of it, but what was the number? 173, close enough for government work? What did it come in at? It came in lower than expected, right?
The jobs number came in at 73,000 jobs created in July. 104,000 were expected. You asked me, was I surprised? Was I surprised by the jobs number for July? Was I surprised by the revisions? You know what? Not really. It makes more sense right now. It did not make sense when the first numbers came out. And, you know, I'll just say one thing. We've talked about our own LEI before this, our own leading economic index. Yeah. And we spent some time talking to Josh Brown and Michael Batnick about it as well on the compound when we were there last month.
Right.
You know what's not in there? The payroll stuff. The payroll growth numbers are not in our LEI. The unemployment rate is there. By the way, the unemployment rate does not get revised. The payroll growth, and everyone's talking about revisions now and, you know, the date response bias, and we'll talk about all that. 12 years ago when he created the index, at that time, we never had payrolls in there. Why? Because of this exact same thing. Payrolls get revised. They get revised a lot. Even a year or year and a half after the first initial releases of these things, right? So all that to say, don't be surprised by the revisions. By the way, the BLS on its website says the 90% confidence interval for the establishment survey, which is where the payrolls come from. The household survey is a survey of households. The establishment survey is a survey of about 120 businesses, 600,000 work sites, things like that. The 90% confidence interval is about 140,000 jobs. Okay. That means if you get 140,000 jobs reported, it could be zero. That's what it means. It could be 280,000 too, right? It could be so that's the confidence, a 90% confidence interval.
That doesn't sound very confident. So I'll set you up here, Sonu. May was 125,000 revised down to 19,000. June was 137,000. I think if I read my writing right, but revised down to 114. That's a total of 255,000. Different data pieces, but I saw that was the largest 2-month revision ex-COVID, going back to at least 1979. We saw big revisions during COVID, sure. Why? I mean, this is where we're going to spend a lot of the bulk of it. What happened? Why in the world? You just mentioned confidence and this and that. That's off a lot. I mean, that is still off an awfully lot. What happened the last couple of months? Why did we get revised like that?
Well, one thing is we have seen actually pretty large revisions over the last 6 months. Usually you get negative revisions before a recession, which is not to say, set that aside. We'll put a pin in that. I don't think we're in a recession or we're going into a recession anytime soon, which is not to say 6 months from now. You know, is a different thing, right? So we have seen significant revisions, but these 2 revisions are especially large. Now, one thing is, this is a survey, and surveys are not perfectly accurate. Every now and then, you can see random things, and surveys are especially not accurate during economic inflection points or where there are big things happening in the economy. And guess what? There were big things happening in the economy in May and June.
Yes, there were.
And the other part of it is, part of it is the BLS also has to estimate, okay, how many, they call this the birth death model, right? Without completely getting into the details of it. They're trying to estimate how many businesses are being created, how many new businesses are being created, and how many businesses are dying, how many are being shut down. So there's a model for that, because if they wait for tax statistics, right? The data is there in the tax statistics. We'll be waiting a year, right, for this data to come out. It'll be, or at least 5 to 8 months. So there's a balance between giving us less accurate but timely data versus giving us very accurate or more accurate but really untimely data. By the time you get the data, it could be 8 months. So like everyone's like, including the all-in SPAC guy, right? I forget his name, Ahmed something. I won't even try to say his last name. He's like, why can't the government use tax data and things like, you can, right? And they do, but that takes 8 months. Do we want to wait 8 months before we get any sense of what's happening in the economy? I would argue no. And in fact, the revisions, I would say, make the data more accurate rather than less accurate, because during the initial survey, we get a response of, 40% or so. That's come down over the years. And then, the payroll survey week is about the second week of the month. But over the last 2-3 weeks of the month, you get more data, more responses, things like that. And then that's where the revisions come from, right? So that's one set of revisions. And then about 12 to 18 months later, the BLS reconciles all this with tax data, right? Okay. And where does the tax data come from? It actually comes from the states. And this gets to the fact that even if somebody wanted to manipulate the data, it's so terribly hard to do, because you'd have to go down to the state level.
50 states. You have to get 50 states to agree? Imagine how hard that would be.
Right? And you have to get all the people who are collecting the data on the state side to agree and manipulate the data, because all this data actually comes from unemployment insurance data, which, employers pay to the states, and then states send the data to the federal government. The BLS cleans it up and does whatever it needs to do, seasonal adjustments, things like that. And that's finally when we get what's called the annual benchmark revisions. Remember last August, I think it was last August, people are like, oh, the previous year's
Huge
jobs
jumps.
Released through the 12 months through March of 2024 was revised down by 818,000.
We lost like 1 million jobs just like that. It was like half a joke. Where'd those million jobs go?
If you were arguing that, they're doing this for political purposes, remember, that was election season. That was the worst possible time for the BLS to come and say, we just lost 818,000 jobs, right? True. So there is that. By the way, that was revised. The final number, that was a preliminary estimate. The final number is actually 500,000. Or 509. It was, I think, closer, somewhere between 500 and 600,000. So that it wasn't 818. Finally, when he got the eventual full set of revisions, it was, close to 590,000, something like that, I believe. So all this to say, there are several sets of revisions going on. It's not easy to manipulate these things. And they do try to become more accurate over time. But like I said, there's a balance between giving us untimely, inaccurate data versus timely, accurate data.
So great stuff there. So there's some stuff I read. I want to get your take on this. Bank of America came out and said that labor supply is lower due to immigration restrictions. Yes. They pointed out foreign-born labor force is down 1.653 million the past 4 months. That's a record. Again, ex-COVID, that's a record. And they said, if I can read my writing, stable unemployment rate and steady wage growth, it equals a potential slowdown from constrained supply, not because of lowered demand. Kind of a mouthful, but I mean, is there foreign-born things going on and immigration things going on that are playing with these numbers?
That's a lot. Coming back to July, 73,000 jobs were created in July. That's actually not a bad number. Okay. Last year, we would have said that's a terrible number, because last year in 2023, immigration was running about 2 to 3 million. Right. So more people are coming into the labor force. It's not like all immigrants are coming into the labor force, but a big chunk of them are. And if more people come into the labor force, you need to create more jobs to prevent the unemployment rate from going up. This year, immigration's collapsed. Literally, you said, 1.6 million, something like that, right?
Yeah, last 4 months.
So the estimate is right now for the economy to create just about enough jobs to keep up with population growth. Maybe it just needs to create 50 to 75,000 jobs. So 73,000 is not bad.
I want to jump in. That's what I say, because maybe 2 months ago, you and I would talk, and you would say maybe our economy needs to create about 100 to 120,000 a month to kind of at trend. Now, with what's going on with the labor force, you're saying it's between 50 and 75. I know these are just rough numbers, but it's dropped some, right?
I think so. And which is why 73,000 is not bad. Of course, we don't know if 73,000 is going to stay at 73,000.
We'll take a wild guess on this one. Probably not.
But that's something Powell was arguing too. That was, his comments for several reasons was like a little shocking. But for the labor market, he was like, the labor market is fine. It's in balance because yes, hiring has gone down, demand has gone down, but he also said supply has gone down. And that's because of immigration. So supply and demand are in balance. He's like, we don't need to create 200,000 of 150,000 jobs to keep up with population growth. We just need something half of that.
So is that, again, we'll talk markets more in detail, but we had about a 1.6% drop on Fridays. Everyone was shocked by this. And on Monday, we bounced back 1.5% with a little bit of follow through. We've had some good earnings. Is that because everyone has had a chance to sleep on it and realize what we're talking about here? It wasn't as bad as it seemed, or I don't know. My take is August is going to be volatile, so I'm not shocked we're seeing 1% moves all of a sudden. But it is interesting how Monday we snapped back and everyone just forgot how bad this labor market looked.
What happened is the one thing that didn't snap back was the probability of a rate cut in September.
Good call.
Right? That was everything snapped back. Small caps and sectors, and especially tech, right? We'll talk about tech when it comes to GDP data and CapEx and things like that. But look, the economy is already slowing. David, you can put that chart up of payroll. Payroll growth stalls over the last 3 months. Over the last 3 months, the economy has created, on average, which is why we always take the 3-month average. Folks, always use the 3-month average. Don't use the last month. Yeah. The economy has created an average of 35,000 jobs over the last 3 months, 106,000 jobs over the last 3 months total. That's not a lot, right? But that kind of gels with every other data point we've seen, including, by the way, I'm going to promote it again, our own LEI. We've talked about for 2 months now. Yeah. We knew even before GDP came out, the economy is growing below trend. Is it recessionary? I don't think so. But it is growing below trend.
Listen, our mid-year outlook just came out. We said the second half, we might grow a little slower, but it's not recessionary. That's what we talked about repeatedly for the last month and a half, 2 months. Yeah.
Right. And every jobs report, I know we've talked about the fact that I write a daily note. Every time the jobs report has come out for not just the last 4 or 5 months, even the last year, I've said that job growth, the composition of job growth has been skewed. It's mostly the non-cyclical sectors, government, healthcare, social services.
Let me just jump in. According to the data that I saw, it might have been from you, but it said ex-healthcare, we actually would have lost 98,000 jobs last month. So we're still getting most of the jobs from healthcare and non-cyclical, right? What you're saying?
Exactly. David, we can put this chart up. Job growth would have been negative over the last 3 months, if not for healthcare. The economy created about 106,000 jobs over the last 3 months. Healthcare and social assistance jobs were about 204,000.
Okay.
So you take that out, 98,000 jobs lost over the last 3 months, right? In the economy, ex-healthcare. And that includes government too. But manufacturing lost about 37,000 jobs. Okay. Professional business services lost 48,000 jobs. Government jobs fell by 49,000 too. So there is that. That's mostly because actually defense jobs, for whatever reason, fell, and that rebounded in July. There's noise around this, right? Going back to your question of what obviously part of the big revisions was, response biases, things like that. And the other part of it is state and local government education jobs. About 20 to 25% of the revisions is because state and local government education jobs are really messy. And ever since COVID, because of, school timings, things like that, even in Chicago, our school ended, in the second week of June. Usually ends in the first week of June. That's because last year the Democratic National Committee had their convention in Chicago. So school opening was postponed by a week. And so that messes up, the timing of when teachers leave their jobs and come back in, the seasonal adjustment. So that whole thing is a mess.
Well, I'll just jump in for a second. We talked about that big spike in initial claims back earlier this summer.
Yes.
And you said this exact same thing. Listen, don't get too worked up about it. There are some wonky things around the state, local, mainly because of education and schooling. And sure enough, 6 weeks in a row, initial claims went lower, up 1,000. This thing is 218 or 219. So initial claims are no worry. So maybe, again, this is playing out.
But that's the other thing, right? Initial claims. I mean, you've asked
no
me
worry
on
there.
Stage, right? You've asked me on stage at Excel. If you had to pick one indicator, I'm not going to be pinned down by one indicator. But if I had to pick, it would be initial claims.
Yeah.
Right? It would be initial claims. Initial claims are telling us that layoffs are really low. The JOLTS report, job opening and the labor turnover survey, layoffs as a percentage of the workforce running at 1%. Before the pandemic, we were 1.2, 1.3%. So There is like on Friday, suddenly everyone woke up to the fact that, oh my God, the labor market is weak. Hiring is weak. I'm like, we've been talking about this for a while.
Right.
But at the same time, I don't think it's cause for like absolute panic. It's not, things are not crashing. It's slow. And I think rates should be lower, but I don't think we should be panicking.
I mean, so let's put it again. We had one of the big shock to the system with tariffs, right? So uncertainty, companies maybe doing things there. You got the labor stuff we just talked about with the wonkiness of the calendar. You got these different things taking. Oh, then the immigration, potential restrictions. You put all that together. The last 3 months, maybe it's not surprising we're seeing these large revisions. No one's crazy about it. To be clear, but at the same time, it's what we have, right? It's just we have the data that we have. If you really want solid economic data on the economy from the growth point of view or from a labor point of view, I guess you got to wait 12 to 18 months, right? I mean, that's the way to put it.
The biggest revisions you see are during economic inflection points. That's when you have a lot of flux in the labor market. And we've, I don't know if it's an inflection point. Like I said, we don't think it's a recession. But we had, immigration policy, exactly what you said. That's changed a lot. Yeah. Tariff policy, that's changed a lot.
That's changed a lot.
So we had enough in there. Like you would expect things to be messed up. But at the end of the day, look at the totality of the data. Initial claims are low. Unemployment rate 4.2%. I think that hides the weakness in hiring because supplies come down.
4.2%. I mean, that's pretty darn low. That's still positive.
Low. Yeah, right. Exactly. Right. And then wage growth. You brought this point up yesterday, and then I got thinking. I'm going to write about this because I think it's a very important point. We got the employment cost index last week. Yeah, it sort of got missed in all the rest of the data.
It got lost in the shuffle on Friday. That's for sure.
But that is the gold standard of wage growth. We get average weekly hourly earnings, from the payroll report, but that's noisy. It can be revised and depending on, are more higher paid jobs being created versus lower paying jobs that can skew those numbers, right? But the employment cost index are just for all of that. It comes out only quarterly. Wage growth is running at, I would say 3.5%, 4%. If the labor market was really weak, that would be a lot lower.
Okay. Good. It's well said.
Right? I started thinking about it because you brought that up. I was like, that is a good point. And I just didn't have time to think about a lot of this stuff last week. I was like, And if you're running at 4% wage growth, that's higher than pre-pandemic, by the way. Right? That doesn't tell me that the labor market is crashing and burning or anything like that.
And to reiterate this, on the JOLTS report, I believe the layoffs run at 1%. Pre-COVID, it was like 1.2 to 1.3%. So we're simply, listen, hiring slowed, people quitting their jobs have slowed, but also layoffs have slowed. So we're just kind of in this, I don't know, kind of stuck labor market. Thank you. Holding pattern. We've talked a lot about this. I do want to point this out. You've hinted at it. Some of the numbers I saw confirm with you, but their response rate. So what is this non-farm payroll we're talking about? It's a survey of 120,000 businesses and government agencies. So there's a lot of places they go out to collect
600 work sites.
600,000. I thought 600,000. Yeah, 600,000 work sites. And apparently only about the response rate lately is only about 40%. Compare that with about 60% pre-COVID. They're not getting as many responses. If you don't get many responses, you can get bigger swings, and you get more of the data later when they finally respond, or you collect it different ways. I don't exactly how it all works, but the reality of those are some of the reasons we've seen this. Exactly. Now let's put a bow on this because we could talk all day on this. President Trump fired Erica McIntyre. He's allowed to. I don't know. I don't know what to think of it. I'm not sure people are crazy about it because it is awfully hard, like you just said, to truly do this. We've seen times under President Biden, things weren't that great. So I don't know if it's as nefarious as we think, but what's your take there?
The negative spin on that is that this is terrible. And Trump's going to manipulate the data.
Well,
The positive spin is that because of how the data is collected, there's no way they can manipulate the data.
Right.
So there is that. So it doesn't matter. I'm not saying the firing doesn't matter. Obviously, she's a very well-respected researcher. She's been there for a long time. Yeah. And, you listen to anyone who follows the data carefully. I mean, she has no control over it. It is what it is, right? So there is that. I'm not saying the firing doesn't matter. I don't mean to imply that. But it's not easy to manipulate this stuff.
Yeah.
Right. Yeah. And I think anyone who follows this stuff carefully, goodness, you and I went ever since our first podcast, what do we talk about? The official inflation data doesn't make sense. Right?
Because of shelter. We're not going to get into it, but shelters the whole time. Yeah, used cars and shelter said it should be lower.
So all of us use even private data to complement what we get from the public side. The public data matters. By the way, if it was so easy to get an accurate set of data, trust me, some Wall Street hedge fund would be doing it and making a ton of money on it. But trust me, there's nobody doing it. I don't think if it's Renaissance or anything nobody's doing a survey on the scale of what the BLS is doing. 600,000 work sites across the country. And even the household survey, there's a second survey. The household survey is a survey of 600,000 households. That's much more noisier, but that's where the ratios are helpful, right? The ratios come out of that data set, the household survey, unemployment rate, employment population ratio, all of that stuff. The prime age employment population ratio did fall from 80.7 to 80.4%. That's a big drop, but 80.4% is not bad.
Right. Okay.
So we'll see where it goes. 1 month is not a trend. That's all.
Right. Well, no, we probably need to move this forward, and we'll kind of maybe talk about Powell. President Trump, the day it happened on social media, said Powell should be put out to pasture. So I like to read our President Trump quote. So we'll talk about the Fed in a second. Let's see. Maybe we'll break it up and have something a little more fun here for a second. You guys did a lemonade stand up in Chicago. You shared that on LinkedIn. The kids did a lemonade stand. Did you teach them about capitalism? Did you teach them about lemonade? Did you teach them about giving? What all they learn up in Chicago?
The first thing, we're writing down, before we set it up, we're like, okay, let's write down all the costs, because otherwise they make money and they think, oh yeah, this is all for us, right?
Oh,
we sell, but
I'm
profit. Like, no. We won't charge for labor. And I spent somebody told me, oh, you guys should just use the lemonade powder. And we're like, no. I'm going, I'm using lemons.
Gotta do this right.
Yeah. So you bought about 40, 45 lemons. That itself costs like $20, $22, right? I mean, we're in Chicago, so I don't know how much lemons cost elsewhere. We didn't go to Whole Foods for lemons, thankfully. Otherwise, that would be, So I'm like, okay, that's not too bad. We can make a little bit of a profit. This is pretty good. And then my wife tells me, oh, we bought cups, 50 cups. For $16. I'm like, what? Who buys 50 cups for $6? What kind of cups do you buy? Gold cups or something like that? And then she was like, no, my daughter Rhea, she was like, the cups needed to be super cute. I was like, so I was going into this whole thing, like this whole enterprise is doomed, right? We can barely eke out a profit. We've spent $46. At most, we can sell 50 cups of lemonade. So that's $50. So we have a 4% profit, 8% margin. So that's not bad as lemonade stands go, I guess. But I was like,
I don't know. Sounds good.
But the capitalist in me is like, we could have made more, right? But then my wife tells me, oh, we should have a tip jar. And I hadn't thought about that at all. I was like, oh, why should we have a tip jar? I was like, okay, fine, we'll have a tip jar. So they sold 50 cups, which is great. The Cubs fans and the kids learned a lot, right? All these random, it's not like the neighborhood people came. A couple of neighbors came by. But it's the middle of the day. They were doing some other stuff. A lot of people are traveling. But all these Cubs and Orioles fans, they were passing through where we are. Okay. As you know, we are very close to Wrigley. You and I walked out there.
Yes,
when you were here.
Mm-hmm.
And
when I saw the national champion Ohio State Buckeyes play in Wrigley Field, we'll just throw it out there.
Yeah. Yes, that is true. That was the season, though. That was the season to see it, right? It's on their way to the national championship.
And I almost died. Remember that? A guy literally was wasted. A guy was wasted.
Oh my God.
Thank goodness we can laugh about it now. Yes. He fell 3 stairs. We were in the front row, and over us was like, I don't know, a 30-foot drop.
And you were standing.
I was standing. And this guy bashes into me. I didn't even know he was there. He just bashed into me, and I just smashed into the front. Like, if he had hit me
the railing,
onto the railing, if he would have hit me a different way, who knows? Who knows who'd be doing this podcast right now? Wouldn't be me. Thank God I made it. But anyway, you never know. You never know.
Yeah. So Cubs fans walk by, and the kids learn to, say hello, and, you want some lemonade. And initially my son was like, please, can you buy some lemonade from us? We are like, hey, hang on, you can't do that, right? So finally, he pulled back on that. And then, but a lot of people, obviously didn't want lemonade. And we had a Venmo thing as well. So that was convenient.
Oh, wow. Okay.
So it wasn't just cash. So we did get some Venmo. And, but then they, when people said, no, we don't want lemonade. And, they were like, okay, thank you. Have a good day. So they learned that little bit of, being polite, being patient, and There was a stretch of like half an hour. There was nobody, right? So they had to. They're like, "Can we done? Can we go inside? Can we get an iPad?" They're like, "No, you got to wait, right?
Yeah.
You're in this. We are in this together." So finally, they ended up they sold 50 cups. They made $4 profit on that. Okay, could have made more if we spent less on the cups, right? But they got $64 in tips.
Wow.
64. So that became like 136% margin, right?
Ooh, look at Sonu. Got all the numbers on there.
Right.
Yeah.
So I made them calculate all this.
Yeah,
all
look
stuff,
at this.
Right?
You,
so it was fun. It was my first lemonade stand, by the way.
I think you're gonna have another one after hearing all this.
Yeah,
you're like, get up. You're ready to go do it again. Next time there's something big going on in Wrigleyville. Yeah.
You guys should come by.
Well, that's good. I mean, my kids, when they were younger, did one too. It was free. We said free lemonade, and the thought was just give tips only. And yes, you make a lot more. You almost should put it on like LinkedIn next time and say, hey, here's the Venmo if you want to help my kids. You could, who knows? But listen,
there's a thought.
We need to go forward. Let's that's a good little break because we're going to talk about the more serious stuff again. Jerome Powell on Wednesday, like what you kind of hinted at, we kind of talked about it. No change to interest rate policy.
No.
He was quite hawkish during the Q&A. The percentage chance of a rate cut in September dropped down to like 40%. Now it's like 90 now after the weak jobs number that we just talked about. But he kind of said things were okay. And then the labor market said, maybe not, but a lot more confusion. What's your take on the Fed now? I mean, let's go this route. If it's, I guess, ballpark 90% chance of a cut. I mean, they kind of getting backed into having to cut after this labor news, right? What do you think?
I was around 50-50 before the payroll report.
Right.
Mm-hmm. I haven't really moved. Maybe 60-40 they'll cut.
Okay.
There are 2 inflation data points to come. We'll talk about inflation. I think we have a little bit of an inflation problem. And I'm not just saying that because, of whatever. Last 2 years, I've been in the camp that inflation is not a problem.
Mm-hmm.
We've literally had episodes titled that. Inflation not a problem.
And that wasn't popular because everyone told us it was a problem. Like
right.
For years, we were told that. Yeah.
Now I think, is it as much of a problem as it was in 2022? Definitely not.
Right.
But I do think we have a little bit of a problem. I think it's a little bit of a problem, but it's a problem nonetheless. So that's essentially what Powell is getting at. He had every opportunity during his press conference, especially, to signal a rate cut in September, or even sound open to the possibility. He went against that, right? He said, look, we have 2 mandates, stable inflation, maximum employment. He thinks we have the conditions in place for maximum employment. So which means one part of the mandate is done. The employment stuff is done. Right. Why? Because of what we talked about. Labor, supply, and demand are imbalanced. Now, demand, yes, it's gone down, but supply has also gone down because of immigration. So he thinks, okay, that's in balance. We're okay there. But inflation's elevated, right? Yeah. And this is the thing. Somebody asked him, do you think tariff-related inflation is going to be a one-time increase? I think everyone kind of agrees with that. Nobody is using the word transitory because for obvious reasons. So they asked him, why shouldn't you look through it? And here's where I think he took a direct shot at Trump and everyone asking him to drop rates. He's like, we're looking through core goods inflation right now by not raising rates. So he's almost saying, be thankful we're not raising rates now, right? Forget anything else. If, we didn't look through this goods inflation that's happening, and we'll put up a chart on that, we would actually be raising rates, right? So what the Fed wants to see is what is the impact of tariffs and consumer price inflation? They think it's going to be a few more months. It's not going to be just 1 month. It's starting to show up already. Look, there's a lot of tariff revenue being collected. You and I talked about this last week or the week before, and we know foreign exporters are not paying that. Right now, it's being paid by U.S. companies and retailers. Not quite consumers just yet, but businesses are telling us during earnings, they are expecting more of the cost to be passed through from August onwards. Right. So Powell's also expecting that. And he doesn't think this is going to be a quick process. It's going to happen over the course of months. And that's why before the September Fed meeting, we have 2 CPI reports. So that's why I'm still at 50-50, maybe 60-40. I'm not at, we're going to get a cut.
So we hinted at this last week on the podcast, Facts versus Feelings podcast, that Waller and Bowman both dissented. First time we've seen 2 dissensions since December of 93. Because we like to do this, at least I do. I always smile when I do it. President Trump on Wednesday said, he's too late, he's too angry, he's too stupid, and he's too political. And he also said he's a total loser. That was President Trump's take for not cutting.
I must
that's
say,
public. That's public. It was on his social media. Can't say without a straight face. Now, I will say this: Goldman actually said they should cut now. Like Goldman came out and said, "Hey, they should cut now. Now, just make it fun." Bank of America and Morgan Stanley came out after Friday, the jobs number. They said no cuts this year. So we are just seeing everything in the sun. Maybe the truth is somewhere in the middle.
Look,
What else do you want to talk about here?
Camp that we talked about this.
Oh yeah,
that they should have cut back in January and March.
Exactly.
And then they wouldn't be in this problem. They could have said, okay, now we're waiting. But rates are at least 3.5. It's not 4.5, right? Or 4%, something like that. But now, like I said, they have an inflation problem. If inflation comes out for the next 2 months,
did you have an inflation chart? Did you have one you wanted to share right now?
Yes.
Let's put that up there. Which one?
The core inflation stays stubbornly high, David. Let's put that chart up, right? Let's look at the inflation data. So basically, core inflation has run about 2.7% for 14 months now, right? It's not gone down. Now, what's driving the inflation numbers? What's keeping it elevated? It's not driving it high. What's keeping it elevated? We know shelter is going down. And in core PCE, the personal consumption expenditures, shelter matters less. When CPI comes out, we talk about shelter having such a big impact. It's 45% of this core CPI basket. It's only about 17% of the core PCE basket. So it doesn't matter as much, right? But we also seeing disinflation in travel and other things. By the way, it's financial services prices too, right? Financial services prices dragged down core PCE by 40 basis points over the last 3 months. So core PCE over the last 3 months running about 2.6% annualized pace. But that is because stock prices fell from February through April. What's happened since then? You and I have talked about it, right? Stock prices have gone back up. That's going to show up in core PCE when you get the next 2 or 3 numbers, right? So there is a lot going on with respect to disinflation. Right, shelter, lower demand. That's because obviously the labor market is weaker, less hiring, and you would expect less spending because of that. But what's counterbalancing that is tariff impacted inflation on goods. Right, durable goods in June rose close to 6% annualized. Last 3 months, it's running at 4% annualized. That is the fastest pace, outside of COVID since 1991. Think about that. Forget the COVID part because supply chains, we know what happened, right? But the 3-month pace of 4% annualized inflation for core goods is the fastest since 1991.
All right. So you'd never know this, but my power went out for a half a second, and we're doing this 30 minutes later. I just literally did a TV hit with my friend. I'm huge in Canada, by the way. I just did a BNN. Shout out to Canada BNN. So do you?
That's why you got shut off. Don't say that.
I don't know what's going on.
We just put 30% tariffs on Canada.
Oh no, that's true. That's true. I believe we're trying to remember what we were just talking about, but I think we were wrapping up inflation. But we got 2 more things we want to talk about in 10 minutes. Want to put a bow on inflation here?
Yeah, I think I was talking about core goods inflation. It's coming out harder than expected. And the big question for the Fed is, I do think we have a little bit of an inflation problem. And core goods inflation for the Fed is, how high is it going to go? How long will it continue? Because there are going to be lags in the official inflation data. We know that. And how much will it be offset by things like shelter and all of that, right? So that's why I think there is a likelihood, not a small 0% chance, it's higher than 0%, maybe close to 30-40%, that they stay on the sidelines till November.
Okay. Well, we're going to watch it. We're going to keep watching that one. Look at AI for a second. And I know we've got like 5 minutes for this. I want to talk markets for 5 minutes, but just high level, we've looked at Microsoft, Google, Amazon, Facebook. Not a recommendation. This is what they all said.
Incredible.
You look at them in 2023, it was $151 billion for CapEx for AI. In 2024, it was $246 billion. This year, it's estimated $320 billion. If you look at the 493, okay, in terms of what they did in 2024, CapEx for AI was up 4%. The Mag 7 was up 40%. All right, that's a stat from our friend Ben Carlson over at Ritholtz. RenMac had maybe the tweet of the year. I don't know. I'm sure it was Neil at RenMac. And we have a rule. We have to quote Neil every week. So this way I can do that. CapEx spending, and they consider that information processing equipment and software, as a percentage of GDP this year is greater than the consumer. What the consumer is adding. Consumer is 70% of the economy.
And we have a chart on that. But AI spending is eating the U.S. economy.
Got it. Okay, put that one up right now for David then. Okay, Sonu, in a couple minutes, what's going on with earnings and AI? Or GDP AI earnings? I don't know. However you want to spin it, but what's going on there?
While this chart is up, over the first half of 2025, AI spending, as you mentioned, IT equipment computers, peripherals, things like that, plus software, right? It's mostly equipment, but including software, contributed an average of 96 basis points, 0.96%, close to, let's call it 1 percentage point to GDP growth.
Close enough for government work.
Average of 1 percentage point to GDP growth over the
Actually, close enough for government work would be 20%, given that conversation we had about jobs and how far off they were. I'm teasing. Anyway, go ahead.
And like this can be revised too. I do think this is being underestimated, by the way. I think these numbers can be revised higher. Okay. The biggest, revisions in the data, the hardest thing to measure for the government is actually investment. Right. And this is where all of this is captured, right? IT equipment investment, software spending. So contributed about 1 percentage point to GDP growth, averaged over the last 2 quarters. Consumption, which is 70% of the economy, contributed just 0.7 percentage points. Right. So right now, AI spending has been larger than consumption. This is a complete reversal over the last 2 years. Right. 2023, 24. Consumption contributed about 3 percentage points to GDP growth, 2.9% on average annualized pace. That's why GDP growth is running at 3%. Right now, we would be at stall speed if not for AI, right? And I'll put this one chart about AI equipment spending. So this is, David, you can put the chart on the AI spending boom taking off. If you just look at GDP data, and this is why I think it's actually underestimated. But, we'll find out in 2 years what the actual numbers are.
Stay tuned, everybody.
But equipment spending on computers...
which, by the way, let me just jump in. This is episode 147. Thank you. We've hit some records. Please give us your likes. Give us your comments. Go to the YouTube channel for free and give comments there. We're allowed to do that now. Episode 150, we're not going to give it away. But we have an absolutely huge guest. It will be a repeat offender. I'm not going to tell you how many times I've been on because you might figure it out. But if this all goes through, episode 150 is one you're not going to miss. Not that you ever want to miss, but yeah.
We have 2 exciting guests coming up over the next 3 weeks.
You know what? Yes. That's true. Next week, goodness gracious, we're recording on Friday with a huge one. It's a first-time offender. Next week, you're going to love them. We're talking technicals. That's all I'm going to say. But for episode 150, it's one of the biggest people in the industry. So we've got some big guests coming up on our podcast. Hopefully, you're going to love it. All right, Sonu, let's try and wrap it up in 5 minutes. What do you want to say about AI or put a bow on it?
AI spending boom in the GDP data, like I said, this is going to be revised probably upwards in 2 or 3 years from now. But anyway, investment in this category, IT equipment, it's up 65% over the last 2 years, last 8 quarters. So that's, you annualize that, it's about 28%. 28%, that is a lot, right? That's a lot. Now, over the last 6 months, it's running, Ryan, 83% annualized pace at 35% over the last 6 months. You annualize it, you get to about 83%. That's that AI. You can see it on the chart if you're on YouTube. It is simply taking off, right? And that's essentially what's, saving the economy's bacon, so to speak.
Well,
let's stop there.
I mean, listen, we don't want to waste bacon, so let's just say that. All right, so we do have a hard stop. We have a meeting coming up, and in the middle of today's podcast, again, we took a 30-minute break. I did a TV hit. Just you never know. You never know how these facts versus feelings are going to go. Let's talk about the market for a minute.
Yep.
2 weeks ago, every single day, I called it the golden week. I don't know, people call it different things. Perfect week. Every day made a new all-time high. All right, that's pretty rare. Then last week, every single day, the S&P opened, whatever it opened at, it closed lower all 5 days. It's the first time in the history of markets that I go back 1970 with reliable intraday data we've ever seen that, where 1 week makes a new high every day, and the next week you see weakness throughout the day. The other one, the S&P 500 equal weight, that was down all 5 days last week, okay? So what I'm getting at, there's some internal volatility, internal weakness. If you look at the percentage of stocks above their 20-day moving average, that peaked way back in the middle of May. It's been weakening the last couple of weeks, whereas the stock market, quote-unquote, has gone up. But my big thing, we talked about this a little last week, I think August is going to be volatile, right? Buckle up. After a 28% rally, August is volatile. We saw a 1.6% gain on Friday, a 1.5% drop on Monday, or other way around, a 1.6% drop on Friday, 1.5% gain on Monday. Who knows what's happening in the time people listen to this, but I think this is kind of par for the course. It's not necessarily bearish. Maybe we're due for a well-deserved 5% peak to trough correction. By the way, if we go down to the 50-day and we go down to the previous February peak earlier this year, that's around I forget the exact number. I had it written down somewhere. 6,070. Around 6,070, that'd be about 5%. Okay, that'd be kind of normal. I wouldn't be too worried if we did that in the whole scheme of things. Last week we talked about how August historically, the last 6 times we had a second-term president, August has been lower, right? I mean, that's just something to think about. Now, one more thing for everybody, just to leave on a positive note. When you're higher in May, June, and July, this is a chart, David.
Okay.
We'll put this chart up, last chart of the day. When you're higher in May, June, and July, like we were this year.
I see a lot of greens.
Yeah, the rest of the year is higher 15 out of 17 times. Yeah, 87's in there skewing everything. But 15 out of 17 times with an average return well above average, 5.8%. But the median
takes out things like 87 and all
yeah,
that.
The median's over 8% takes out, and that's really impressive. The next 12 months is up, again, 87 or 88% of the time, higher about 14% on average. So listen, this is still a bull market. There are some weaknesses. There are some cracks, maybe some near-term volatility. It's August, it's September, it's October. I wouldn't be shocked if we had a couple scary days and everyone blamed it on whatever they want to blame it on. Maybe it's just the market needs a little bit of a break. And that's something that we're trying to stress to our Carson partners and their clients. And we've been spoiled. We've been bullish. You listen to this podcast, you know our stance. But maybe it's time for a little bit. Sonu, looks like we're almost bottom of the hour. Any final, what do you watch? This week's calm. Anything else going on besides you going ready to take a nap? It's been a heck of a day already. I don't know.
I'm getting ready for vacation. That's what I'm getting ready for.
Oh, that's right.
Right. I'm going to spend those $64 in tips that my kids got.
Yeah. So last year, Sonu went on vacation the first week of August, and all we had was a yen carry trade unwind. And literally, by the way, a year ago today, the time we're doing this, was when that really went crazy. When Japan had its worst days, 87.
So August 5th.
August 5th, the VIX spike above 50. We had a 3% drop on the S&P on the heels of down 1% Thursday and Friday. And we went to bed that that Sunday night, knowing it was mayhem out there. So listen. Things happen, and it's just the way it goes. But here we are a year later. I think 15, 16% a year later, give or take. So just something to remember. But have a happy vacation. Please don't bring the volatility like you tend to do when you take vacation.
I just want to be out in Utah enjoying the scenery and without thinking of markets. I know I will be thinking of markets because I'm already thinking, where will I be on Tuesday when CPI comes out? And see,
oh, jeez. Yeah.
You know.
We're addicted to it.
Yeah, we're addicted. It's our own fault. But I'm excited about next week's guest. We talked a ton about the fundamentals today. So
yes, we did.
We'll switch it up next week. We have a perfect guest for that.
Yeah, a lot of macro talk today and a lot of tactical talk next week.
Yes.
So again, this was episode 147, I believe, right? Yeah, 147. Yep. You're fired. A lot of stuff going on out there, but again, we're excited. We've literally been crushing our previous records and downloads and stuff like that. So thank you so much to everybody who takes a lot of time to listen to what Sonu and I have to say, and the entire Carson Investor Research team. It means a lot to us, and we're going to keep doing them if you guys keep listening to them. And we have a lot of fun. And again, we got some huge guests coming up, specifically starting next week. So we'll see everybody then. Sonu, have a safe vacation, happy vacation. So we'll get some updates. I guess it's technically 2 weeks on how your vacation went. We're pre-recording next week's. And with all that, everybody, enjoy August. Buckle up. See you next week. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.